back to the channel. I'm here doing my January portfolio update. Even though we're 2 weeks into February, I do apologize for that. I'm pretty busy at work. I'm coaching basketball, an assistant coach for basketball and track now. So my schedule anywhere between November and April is pretty busy between practices, games, things like that. But I'm still going to get these reviews done. So I'll be doing 2 reviews in the month of February. One for January, like I'm doing now, and then one actually for February at the end of February. I made some changes to the portfolio. You can probably already tell now. One pretty big change is that I sold out of T. Rowe Price. So United Health Group had like another, I think it was a 20% drop in their stock price about a week and a half ago after they got some bad news with I believe CMS came out and said they were only doing like a 0.01% raise to rates. So that kind of caused the price to fall for United Health. I think every health insurance company pretty much kind of sold off a little bit because of that news. Everyone except for Cigna. Cigna's probably been the best performing health insurance company over the last year, and it's not even close as far as the share price is concerned. Cigna's not a pure play health insurance company. They do a lot of other things in the healthcare space, but their stock price has been it was flat the last about year or so, and now the stock price is starting to rise versus all the other health insurance companies whose stock prices were declining, 40, 50 plus percent over the last year and a half. But I'm not going to get to make the video too long. I want to make this a quick update video. I am now using Dividend Data. I like this platform a lot more than Snowball. There's some things that are on Snowball that I like that Dividend Data doesn't have, but it has pretty much everything that I could ask for on this particular platform. So I'm no longer using Snowball Analytics. I'm going to be using Dividend Data. If you ever watched the Dividend Data YouTube channel, the guy who runs that channel, this is his platform. I think he's a software engineer. That's his day job. And so he designed this particular platform to help track stocks and dividends, since he is a dividend investor. And I think he's done a pretty really good job with this platform here. But yeah, like I said, just updating the portfolio. I now have rolled my my gains from T. Rowe Price. So I think I bought at my average price that I bought at for T. Rowe during that tariff day sell-off, which in hindsight, there were better companies that I could have invested in, but I'm not mad at it. I'm going to count that T. Rowe holding. It's like a swing trade because I held it for about, it was April. I bought that last April, and now it's February. So it's been about 8 months it's been about 10 months that I had that held that T. Rowe position. So I was up 20% when I sold. I think my cost basis was like 2,700 or the high 2,600s, and I walked away with once I sold about $530 something worth of gains. So overall, I was able to put $3,100 into a little bit over $3,100 into United Health Group from that T. Rowe holding. Plus, I also invested an additional $1,500 out of my pay for this month, out of my pay last month in January, to bring my total holdings in United Health to 17 shares at a cost basis of $4,801.19. Also, just a heads up, kind of a spoiler alert for my next video, I will be selling out of Western Midstream. I'm a real big fan of these midstream companies, but it's a general rule of mine. I don't like to buy companies when they're trending toward their highs. My only exception to that is investing in midstream companies, even if they're at their highs, just because I'm that bullish on that particular business and the energy sector as a whole. However, I think with this software sell-off, you have stuff like Microsoft is selling off Badger Meter, although it's not a software company. It's technically it's a hardware company, but they do have a software aspect to the business. I'm not saying that the software sell-off is affecting BM Badger Meter strictly because they deal in software as well, like they're affecting ServiceNow and CRM, but I'm just going to kind of lump that in there. It's kind of like it's a tech slash hardware slash software company, and they manage water flow technology and stuff, well, liquid flow technology and other flow technologies as well. But I'm with that sell off happening, I'm going to be trying to put the money from Western midstream into other beaten down sectors. I think these midstream companies are pretty much run up. So if I go here and I look at all the midstream companies, you have EPD. EPD's been at you could have been buying this at 29, 30, $31 the last like 2 years. Their stock price has been pretty flat, but now EPD is done with their CapEx expenditures, and the management team has indicated that they're going to be returning a lot of value to shareholders through dividend increases and share buybacks. Primarily, share buybacks is how they're going to be returning value to shareholders now that they've finished their $1 billion CapEx expenditures, which a lot of people are kind of on the side note. A lot of people are wary of CapEx and they don't like CapEx. And every time they hear a company talk about, CapEx expenditures, normally when a company talks about CapEx expenditures, their stock price takes a fall the next day, over the next 2 days, 3 days that week. Same thing with Amazon. They announced $200 billion worth of CapEx that they plan on expending, and their stock price took a nice little dip. So I personally like to invest in hard asset businesses. I don't think that capital light businesses are better than hard asset business. I know a lot of these software companies, the valuations got high, stock prices got high because they're asset light. They don't have to worry about spending money on pipelines, or spending money on, if you're a REIT, on buildings. They don't have to worry about spending money on assets. They're just managing people, managing software, stuff like that. But I personally am a big fan of hard asset businesses that own a lot of hard assets, and I don't count those businesses spending capex to increase cash flows and increase productivity in their business. I don't count that against them, and I don't hold that against them when they make those announcements. So with EPD, they're done with their capex expenditures, so they're stating that they're going to be returning value to the shareholders through those buybacks. So the stock price for me has gone up too high. I like to invest when stocks are beaten down. I don't like to invest when they're breaking out. So how the time worked out with me investing in these it'll take me back. How it worked out with me putting all of my money into the healthcare sector. This sector was pretty beaten down, and it still is beaten down. But I just didn't have time to. When I reallocated, at the time when I initially bought Western Midstream MPLX, I was buying Western Midstream when it was at like $37, $38. I think I got a couple shares even at 36. I was buying MPLX at like 45, between 45 and 48 was my average cost basis when I had about $5, $6, $7,000 in those midstream companies. But now when the healthcare sector went on that massive sell-off, when I reallocated into the healthcare sector, I just think it presented a better opportunity for me over the long haul. And now when I was trying to reallocate back into not reallocate, but put new money back into the midstream space, these stocks have already started to run up. And just a general rule that I try to follow is that I don't like I said before, I don't invest in companies. I don't try to put my money in a company whose share price is breaking out. My only exception was for these midstream companies, but however, they're a lot of them have gone beyond their 52-week highs. Like I think this Western Midstream 43.70, I'm sorry, the 43.43 price. I think that may be it's like $2 off of an all-time high, and they're probably going to smash through that all-time high in probably a week or two. If things keep going how they're going, I think they'll smash through it a couple weeks to a month. So at this point, I think this is better opportunity. So I will be selling out of this Western Midstream position. More than likely, I'm going to be adding that to United Health Group. So if I run over here to my pie, just to give you guys kind of a insight into how I'm thinking about it, if I can find, I'm still kind of new to the platform. Oh, right here, diversification. So I know I have my $100,000 goal. That's like a short-term goal for me, but the goal after 100,000 is getting $200,000 of money invested, not money invested plus gains, just strictly money that I take from my job or wherever I get the money, put it into this portfolio. I want to get it to 200,000 after the 100,000 mark. So how I'm looking at it is that I'm going to have, right now you can see I have $15,704.66 in the healthcare space, divided up between Elevance Health, United Health, and Novo Nordisk. My plan is to get $20,000 into the healthcare sector, and then that'll make up 10% of my 200,000 that I plan on having in this dividend portfolio. At least the second goal of this dividend portfolio is to have $200,000 in it, and the healthcare space is going to make up 200,000 of that. So it's going to make up 10% of that. So right now, once I reallocate that 1897 into United Health, which is more than likely where I'm going to put it, to United Health, I have $17,601 in the healthcare sector, which will only leave me needing to put about $2,400 in there to hit that $20,000 goal or mark for the healthcare sector of the portfolio. And as you can kind of see, I was explaining to my my little brother was talking to me about investing. I was showing him the same thing. My plan is to, the way I want to build out this portfolio is to whatever sector is on sale, I want to put money into that sector that's on sale. And whatever sectors are on sale, by the time I get to that $200,000 mark, that's what's going to make up my portfolio. So right now, the energy sector is not on sale. If you look at EPD, Western Midstream, MPLX, all the, even Energy Transfer was one that I was looking at, and then like a week after I was looking at it, that stock price started to go up from $16 up to, I think it's at like $18.50 now. So that's like a 25% gain in their share price over the course of a month when I began to look at Energy Transfer as well. But the sector that's not on sale is the energy sector. So with the data centers, and now people are realizing that with the population growth and development and everything like that, that energy is going to be a major component of that, and a major requirement for it. Energy stocks are running up. So right now, what's been beaten down recently was the healthcare sector, specifically the health insurers within the healthcare sector. That is where I put my money. Now we have a sell-off in tech stocks. I'm looking at Microsoft, and I'm looking at Badger Meter. That's what I'm looking at right now. As far as tech companies, like I said before, Badger Meter, kind of like a pseudo tech company. A pseudo software company. It's specifically software companies within the tech sector that are selling off. But I'm looking at Microsoft right now for sure. That is one I'm going to be begin adding to. I'm going to start a position in it, and I'll average down if the price continues to sell off. We'll know kind of how the year is going to turn out for these software companies when April comes back around. And there's another little season of earnings in April for these software companies. But yeah, I don't want to make this video too long. That's the plan, is to get $20,000 into these healthcare companies. Novo Nordisk, I'm gonna add maybe a couple $100 more to that, but I want to build out the majority of my position in what I believe is the safest companies within the healthcare space, and that are the health insurers. And the two, in my opinion, again, everything's my opinion, the two premier health insurance companies that you can invest in are UNH and Elevance Health. You could probably put Cigna in there, but again, they're not a pure play health insurance company. UNH and Elevance are also, they're making investments, and they're trying also not to be pure play health insurance companies. They have stuff like Optum, Carelon, their PBMs, things like that. It doesn't make them a pure play health insurer, but they're not as Cigna is more advanced, is more farther along in that particular category than these two companies are. But yeah, that's my plan, is just to continue to build out this United Healthcare position, and you won't be seeing Western Midstream in here. Hopefully, at some point in time, with these midstream companies being linked to commodities. I know they're kind of protected by their contracts and everything from commodity pricing, but still, if you have an oil crash or a drastic drawdown in the price of oil, right, it is a commodity that will affect these midstream companies, or you could just something could happen that could make them sell off. Then I would go back into the energy sector and look specifically at these midstream companies. But by the time February comes around, the end of February, and I'm making the other another portfolio update video for February, you won't see Western Midstream in here. You'll just see more than likely more shares of UNH, or possibly Microsoft, or possibly Badger Meter. Those are the two companies that I'm looking at the most here. Just again to kind of go back to what I was talking about with the energy companies. C&Q was actually another position that I had in older videos in the portfolio, but I reallocated out of that again to put it into healthcare stocks. When I was buying this company, it was at like $29. I was buying my shares at 29, anywhere between 29 and $32. Now the share price is like $40 and 68 cents. You come down here, I owned those shares a little bit over 6 months ago. So it's been a 36% gain in 6 months, plus they were paying a 5% dividend. They're paying a 4.19% dividend, but now they were paying off a 5.5%, almost a 6% dividend, 6% yielding dividend at the time that I bought it, a little bit over 6 months ago. So that would have been a 41% gain over the course of 6 months. I'm hoping and I believe that this reallocation is going to yield me more gains over time. So that's what the more gains over time with less volatility over time. I know there's been a big sell-off and there's a bunch of volatility in the healthcare sector, but I think that that's going to subside over the course of 2026 and kind of into 2027, when things begin to get back to normal and their margins can kind of increase a little bit more from what they are. But that's it. I still kind of went kind of long with this video. I'm gonna get better at making videos and keeping everything more concise. A lot of times I just get on here and just kind of free kind of go a little bit loose and fast. But yeah, I do appreciate you watching. If you enjoyed the video, please like, share, and subscribe. And actually, one more thing, I gotta go over here. So I think previously, yeah, I'm gonna just make sure I get the dollars invested, the change in that as well. So previously, I crossed that $15,000 mark in January. So now we're up to $16,684 invested by the end of January. So a nice little increase. Fun fact, before the whole sellout that we had in the healthcare space because of those earnings and then that CMS news about barely increasing, the small increase that CMS proposed, I was beating the market by like, I think, over 10% year to date. That was only like a couple weeks into January, but over in January, I was beating the market by like 10%. And then after that sell off and the CMS news, I was losing to the market by like 5 and 6%. So I'm just kind of putting that out there to show you that there's some volatile swings when you're investing in these what you perceive to be value stocks that are beaten down. Then you're going to have those little volatile swings in your portfolio, but you just got to ignore that. Keep your faith, keep on investing according to your game plan, and I think in the end you'll come out on top. But again, if you enjoyed this video, thank you for watching to the end. Please like, share, and subscribe, and I will catch you in the next video. Take care.